All right, so let's dive in here, guys. So the ultimate guide to spreads. So what I want to do here is I've just studied options for a long time, and the one thing that I hate about options is that the spread plays have the most confusing names ever invented. And you go to a lot of these seminars, or you go to reading a book, and you're going to hear, okay, they're here. We're going to do a bull bear put play or a bear call spread. I mean, all these things to me, actually, I always had a problem getting my arms wrapped around them. So the one thing I think is that you shouldn't have to think about these things and see what they mean. Okay, and I think too. I think what happens is, and what happens too is that what I found with a lot of these option books, and a lot of the times, frankly, you got to be very careful when a broker, if you're at any class and a broker is teaching you, they're going to show you all these complicated strategies because guess what? They want you to continually leg in and leg out of positions. Why? Because that means more commissions for them. And instead of just like buying a call or buying a put or selling a credit spread, they'll have you legging in. I've seen them teach 8-legged things where it's like iron condors with a butterfly, and and you're doing all this stuff to make like a couple $100, but they're just killing it on commissions. And one of the things that a broker will encourage you to do is, instead of just taking a loss, they'll continue to just, hey, roll it over. Yeah, roll it over. If it doesn't work this time, just roll it over, which I hate. I mean, I just think that is I just think it is the worst way to trade because it creates a bad habit. It's telling you, hey, you know what? Your trade idea isn't wrong. Just roll it over and you can do it again. And it's things like that that just drive me insane, because you want to set this up again. The only goal that we have here is what? You want to have that equity curve that goes from lower left, upper right, okay? And sitting there and legging in and out of an 8-legged spread is not a way to do that. But that's what the brokers like to teach because it generates a lot of money. Generally, people don't lose a lot of money doing that, and they just keep the commission train rolling, and rolling. Okay, and that's obviously not our goal here. Our goal here is not to make our brokers rich. Our goal is to make ourselves rich. Okay? Yeah, exactly. Crafty buggers. So let's simplify this approach. Now, here's the only trades that I do. Okay, there are probably 70 different kind of things you can do with options in terms of the kind of trades that you can set up and things like that. Here's what I do. So I have a column here, what they call it and what we call it. Okay, for sanity purposes. So what they call it, meaning the broker, is they're going to come out and say, okay, we're going to do a bull call spread. And I'm just using Apple as an example here. So that means you would buy a $700 call and then sell the higher up call, okay? And of course, this is a bullish play. You're looking in this case for the stock to go up. In a perfect world, Apple would close at 705, right? And what would happen is the 705 call that you sold would expire worthless, and then you get your maximum profit on the 700. But it doesn't matter. Apple could go to $750, right, and you'd still make the spread. All right. Now, so what they call it is a bull call spread. What we call it in the room is, hey, we're going to buy a call debit spread here. Okay. That, to me, that just makes sense. We're buying a call debit spread. It's kind of like a covered call. Now, I'll be honest with you, I'm not a huge fan of debit spreads. I do trade them, but I'm not a huge fan because in a situation like this, yeah, exactly, debits are money out, credits are money in. Yeah, and you want to be careful. Some of the commissions there. If you just open up an account and you don't try to negotiate, you can get like $3, $4 a contract getting charged to you, which is a little rough. So that's just what we just call that is we're just going to buy a call debit spread. Okay. Now there's also a bull put spread, which to me is the worst name ever. Bull put spread, if you're just listening to what a bull put spread is, I just think that's probably the most confusing name on the planet. How that looks is we're essentially going to sell a put, okay, and then we're going to buy the lower one as protection. That's one of the most this is like the most common trade we do in the room. I mean, I'd say 7 out of 10 trades, and so we could call that selling a put credit spread. Okay, love, love, love that trade. In fact, I'm highlighting in red here my favorite ones that I like to do. Yep, okay, yep, we'll do. And so bull put spread, you will never hear me say, guys, I'm going to do a bull put spread on here, because by the time everybody figured out what that was, the trade would be over. Okay, so selling a put credit spread, to me that makes sense. And all doing a credit spread is, and it's really all we're doing here is we're really, sorry, I got my mouse on this one, we're just selling. Okay, that's not going to work. So let me move my pointer here. There we go. So really what we're doing here when we say we're selling a put credit spread, really what we're doing here, and this is an easy way to remember it, is we're selling a naked put. Okay? That's really all this is. So you're sitting there looking at this going, you know what? You're looking at Apple and you're thinking, wow, I think Apple's going higher, okay? And these $700 and these $705 puts, people are paying like $5 for them. Those are going to expire worthless, so I'm going to sell that to some poor sucker, right? So that's all we're doing, is we're selling a naked put. But then what we want to do, of course, is, we can place a stop there, but what happens is if you sell a naked put, you've opened yourself up to event risk. What happens if you sell a naked put and then overnight Apple gaps up $50, right? You're screwed. So the risk there on a naked put is very, very difficult. So the reason, so what we do then is if you sell the 705 naked, then you want to buy a strike that's up above it as protection. So typically we'll go $5 wide. In this case, we buy the 710 put, and that would be our protection. Okay, so we just call that, we're selling a put credit spread. Really what you're doing is you're selling a naked put, and then for your stop loss, this essentially becomes your stop loss. All right, so that's what we're looking for there. Okay, now, sorry, yeah, my bad. Let's do this again. Let me just redo that again here. Okay, so let's come down here and redo this example. So let's say Apple is at, let's call it $700, okay, and we think it's going to 715. So the $700 puts are selling for like $5, right? And we're like, wow, those are going to expire worthless. So we're going to sell those $700 puts, right? And then for protection, in case it collapses, we're going to buy like the 695s. Oops, 695s. And now, if the stock goes higher, we make max profit. And this is a concept here that I've talked about many, many times, but it is worth revisiting here. And let me see if I've got an empty slide here. That's my favorite snake right there. I don't know if you guys knew this, but I used to, when I was in high school, how I made a living in high school is when I was in 8th grade, I worked at a herpetology department at a museum where they bred snakes and things like that. And I had no interest in snakes at the time, but I got to learn to take care of them and stuff like that. And then I find out that they were breeding these albino king snakes, and that when the babies were born, they could sell them for $1,000 a piece. Okay, and I was in high school, and to me $1,000 was a lot of money. So I had my room set up, to my mom's everlasting horror, with a big cabinet that had 6 big tanks in it, and I had pairs of snakes, albino snakes, in each cage. And I'd try to, put on some mood music and, dim the lights so they could get busy and lay some eggs. And then over here, I had an incubator where you put the eggs in until they hatch, and then when the babies hatch, you sell them. And it was interesting. The market's gone down on it so much. But then what happened is I started getting interested in girls, and girls didn't like snakes, so I closed I liquidated the inventory. So I'm going to, we're going to go back to the slides here, but I want to go back here because I want to go back and emphasize something here that I think is really, really important, because the biggest question I'll get is that, well, if I think Apple's going from $700 to $720, then why don't I buy like the 705 calls? Okay, first of all, because if it goes to 720, I'm going to make a lot of money. Okay, now there's one word that I said in there that is whole key to all of this. Okay, what do you guys think? That sentence I just said, what is the key word in that entire sentence? Thank you, you guys are listening. The key word is if. And I agree. If Apple is going to go from $700 to $720, and if we knew that, we could make a hell of a lot of money buying some 705 calls and holding on until it got to 720. Okay? The reality of it is, as you guys all know from your own personal experience in trading, is that what you think is going to happen generally has no relation to what is actually going to happen. Okay? And here's the main thing I want to emphasize here is if Apple is at $700, okay, and here's the $700 level. From here, it's generally going to do 5 things, okay? It's going to go up exponentially. It's going to go up what I call, steady, okay? Or it's going to trade sideways, or it's going to start grinding its way lower, or some bad news is going to come out and it's going to collapse, okay? And so if you think, okay, if Apple's going to 720, okay, let's call that 720. We can call this 710, 700, 690, and 680. All right. So if it's going to go to 720, yeah, absolutely, you can make a lot of money just buying some calls. Okay. Now here's the thing: if you buy, in this case, if you buy the 705 calls, okay, slightly out of the money calls that have a week. And, okay, so Apple goes to 720, great, you make money. If it goes to 710, you're lucky to break even. So let's call that break even, okay? If it stays there and closes the week at 705, okay, you have max loss, all right? If it goes down a little bit from there, obviously then you have max loss. And obviously if it plummets, you're going to have max loss. So you've set up a scenario here where, yeah, if it goes to 720, great, you're going to make cash. If it goes to 710, you're going to break even. If it stays at 705, you're going to have max loss, and of course this is presuming you hold on to it into expiration. If it goes down a little bit, max loss, max loss, max loss. So you've set up a situation where at any given time, a stock has 5 things it can do, and if you're buying a outright, slightly out of the money call, then even though it can do 5 things, you're making a bet that the one thing that it's going to do is what it's going to do, okay? And if you just look at that from a stat point, you've only got like a 20% chance of being right based on the 5 things that it's doing, okay? And if it doesn't do that one thing, then you're either going to make no money or you're going to have max loss, max loss, max loss, okay? That is not how you build an equity curve that goes from, lower right to upper left, okay? Buying out of the money calls is, a disaster at best. There are some times when we can do some out of the money stuff. I just want you guys to know that, okay? So for a long time, I was not a big fan of spreads because of this. I would sit there and go, all right, if Apple's at 700 and it's got a chance to go to 720, okay, or it could go to 710, or it could stay here at 700, or it's going to, go to 695, or it's going to go to 690. My thought was always focused on, well, gosh, if it goes to 720, I'm going to make a lot of money, and why would I want to do a spread and limit, my gain? Because if it went from 700 to 720, I could make like probably $10 on the option, okay? And if I had 10 contracts, that's like $1,000. And if I did a spread, or hold on, let's do one contract. If it went up $10, yeah, $1,000. And if I did a spread, so directionally, okay, so directionally on that trade, I could make like $1,000 per contract, right? But if I did a spread, it would only be like $200. And that was my thought, is with the spread, I was always like, why would anybody waste their time with spreads because your upside is so limited? Okay? Now, there are times to do directional trades, and we're going to talk about that, but I just want to make sure you guys, this hits home. Okay, so on the spread, it's like, wow, you can only make $200 on a spread. Why would anybody do that? Okay, why would anybody do that? Well, so let's say the same thing here. You think it's going to go to 720, but you decide instead to sell the 695, 690 put credit spread, okay, for, we'll call it $2. So this is the play that you did. Now, here's the cool thing about this. Before, we were looking at a situation where you had to be dead right in order to make money, right? Well, in this case, if Apple goes to 720, you make max profit, okay? If it goes to 710, you make max profit. If it stays at 700, you make max profit. If it falls and goes to 695, okay, even though this is a bullish play, you make max profit. Okay? Now, if it falls to 690, that's then and then is when you hit your max loss, or your loss on the trade, but of course you can have a stop loss in place. So suddenly, this has become a very different situation where the stock has 5 things it can do, and now you've set yourself up for success. It could do 4 of those things, and you could get max profit. Okay? Suddenly when I grasped that, okay, spread trading became much more attractive, okay? Because what can happen here with this, and this is the part that I just absolutely love, because all of us have had a situation. Has anybody here been in a situation, yeah, where you've thought the market was going to do one thing and it did something entirely different, i.e., has our analysis been wrong? Okay, we have all been in that situation where our analysis has been wrong, right? Okay, and sometimes, some weeks it feels like it's, most of the time. What I love, love, love about spread trades, okay, and this goes back to the equity curve, is that with spread trades, you can be wrong, okay? You can even be dead wrong, and you can still make max profit. Now, this really goes back to the whole concept of why are you here? Why are you trading? Okay, are you trading to be right, or are you trading to make money? And a lot of us, honestly, if you really look at this, and this is this is something that I had to go through as well, is that I thought it was important to be right. I was trained as an analyst. You look at the chart, you buy that pullback to the moving average, and you're looking to be right. And then, you focus on these directional trades, and it would get frustrating when the directional trade didn't work out, and you'd always go back and look at your analysis and say, gosh, I really thought I had nailed this. And it becomes this, back and forth, self-doubt kind of a thing about your own analysis on the markets, when the reality of it is, the analysis doesn't mean anything, okay? Which is, I've talked a little bit about that with market makers, is that they realize that when you're looking at a chart, all that has done is told you what's happened in the past. It's not going to tell you what's going to happen in the future, and you never know when that big hedge fund is going to roll out of a position, and even if you've got this great bullish setup, maybe a hedge fund needs to redeem shares and it pushes it down, okay? You never have that. So, as traders, just think about being freed from the burden of having to be right, okay? You're freed from the burden of having to be right, and now you've got an 80% chance of making money on some basic simple analysis tools. Suddenly, this is a different ballgame. Now, this leads us to the one factor that I still don't like about spread trades that I'll show you how I dealt with it. What I did not like about spread trades was that I looked at them as very, very limiting, meaning for potential profit. For example, if I bought one Apple $700 call, okay, and Apple went to 720, then I could make easily $1,000 per contract. However, if I just said, okay, I'm going to sell the $700 put and then buy the $695 as protection, and I'm going to sell that for $2, and then Apple goes to 720. All right, I can only make $200. Now the good news is, of course, is I can make 200 bucks, if it does 4 out of different 5 things, so that's nice. Well, guess what? What I can do here is, and this is what I also do, is that, if normally directionally I would do one contract, then instead of just doing one contract on a spread, okay, you can up that. On a spread, I might do 2, 3, 4, or in this case, 5 contracts, because a 5 contract spread at minus 700 plus 695 sold at $2, then that max profit is suddenly $1,000. And guess what here, guys? Apple doesn't have to go on this 20-point rally, which drags up that call $10 to do that. Apple could go up, it could go up a little bit, it could go sideways, it could go down, okay? It could do any of these 4 things, and I would make my $1,000. On my directional call, it has to go up, and it has to go up in a big way for that to happen, okay? Once this concept sank in, suddenly my whole trading regime just kind of changed around. It's like, okay, if I'm going to do a directional call, I'm going to stick with what my normal size is, but on spread trades, I can actually up that because my risk is contained, but it gives me the same profit objective, okay? Now, good question. So one question there is, but isn't bigger riskier? And it goes back to what it really comes down to is how much to risk on your account, okay? So let's say that you're willing to risk, I'm just going to pick like, for me, an aggressive stance is to risk 5% of your equity, okay? So if you have a $10,000 account, that means that you could risk $500 on a trade. So you could buy one call, okay? Say you buy one call at $10, okay? Then if that call went down to $5, okay, then you'd be stopped out. And you could do the same thing on a spread. And let's say that you sell five spreads, so you sell 5 spreads at 2, okay? And so when you do something like this, then your max loss, and we'll show you how to set up the max loss and stuff like that. In fact, let me just do this as 10, because that's actually easier to calculate. So plus 10 at 2, okay, then what's going to happen is suddenly your max profit is $2,000, okay, and your max loss is $2,500. Well, obviously, if you look at that, you can't afford to lose $2,500, okay? So the first thing you do then is, well, let's try 5 contracts, so minus 5 plus 5, okay, then this falls in half. So now your max gain is $1,000 and your max loss is $1,250, okay? Well, that still does not jive up with your max risk. Well, here's the thing, is that you can actually just place a stop on your spread. So you can just set up a spread and it only risks $500, and that's fine. So there's a couple ways to look at that. Is you can set up your spread where your max loss equals your max account risk per trade, or you just set it up where you can actually just place a stop, which is fine too.